Hey, Keith here for Am I Rich? And today I'm talking about pricing. And I have a question. What do you think would be worth more? The current system of, big major sports franchises where two teams play each other at a time versus what if like three or four played at the same time? Like imagine like basketball or hockey or, some other sport. What would you expect would be people's reaction to having three or four teams play each other at the same time? They're all competing for goals or points or whatever. Do you think it'd be worth more? I don't know. This is something I just thought of recently, and I'd love to know your opinions. But getting on to today's topic, I really want to talk about pricing because I've talked to several people, and when it comes to stock investing, I usually ask them, "Oh, okay, like why'd you buy it?" And some people will say, "Oh, I really love this company," or I thought, "Yeah, it seems like a good company right now." Or if you talk to people and say, "Yeah, I thought I bought it cheap," okay, that's good. And then what do you think it's worth in the future? And then they often, say, "Oh, I don't know. Well, maybe if it goes up 10%, I'll sell." So what it made me realize is a lot of people don't put prices to what they're investing in. So, they often do, but they often don't. And so because they don't, I thought I would just talk about my thoughts on pricing and what are the benefits and maybe how you do it kind of thing. So when it comes to benefits, I think the benefit of putting a price to anything you're going to invest in, the main benefit is actually kind of a mental wealth kind of thing. So basically, if you put a price to something, whether it's above that you pay for it at that price or below, just knowing that price gives your mind the sense of, oh, okay, like I overspent, but I have a reason why I overspent, or I spent at fair value, I'm satisfied with that, or I got spent below what I thought it was worth, so I got a bargain. And so your mind, it's very simple for your mind doesn't overthink it. So I think this is really the main benefit of putting a price to something. Now there's other benefits too, but that's the main one. And because of that, I mean, like if you were to buy a car and you bought a car at, say, you thought it was worth $10,000, but you bought it at $8,000, you thought it was a bargain. So you got that from that. You're mentally, you're happy, and your brain doesn't have to overthink. Like if you just bought it and you didn't know what the price was worth, you bought it at 8,000. Okay, well, what's it worth? I don't know. And you're always second guessing. Was it better? Was it worse? And your brain might have to overthink for no reason. And so this is kind of a deficit on your mental abilities. And I just think that kind of isn't as beneficial as having a price. So then if you did have a price, but what if you found a car for $7,000, the next week, the same car, basically $7,000, you would think, oh man, I overspent. So maybe, but you basically think, okay, maybe my price that I had, maybe that wasn't correct. So the benefit there is that you had a price, and so if you saw the same thing in the future, you'd say, oh, there's a car I think worth $10,000. But then you'd remember, oh yeah, but I remember it sold for $7,000. So maybe I need to put in some kind of margin of safety, or maybe I need to adjust the way I evaluate price. And so it's at least an educational or positive thing for your mind to improve on how you price things. And so that's why I think putting a price is very important in general. Now, as far as stock market investing, it's also nice to have a price because it'll give you that mental benefit. And if you price things right, you're more likely to gain over the long term. So value investors, a lot of value investors, like even Warren Buffett, the maybe most famous value investor, he would say, it's crazy not to have a price put to a company before you buy it. Because if you have a price, then, even if you wanted to put money, invest the money every month, at least if you had a price that you thought it was worth, if it was over that price, you wouldn't invest that month, you'd save, and you'd wait till the next month, see if it's undervalued. If it's undervalued, then you put more money in it, and you'd just be happy that way. It just gives you that peace, and you probably a better strategy, so that over time, you probably would gain more, at least more on the money you put in at that time. Whether you could have gained something in that waiting period when it's overvalued, That's another option. Maybe you can do that. But that's basically, it doesn't always work out, but statistically it would. So that's kind of the benefit there. And even in like day trading, you could have a couple pricing things you could do. One is you could find the intrinsic value of a company. So if it's below that, you feel like there's increased chances. The percentage of chance that it's going to go up is higher. If it's above that intrinsic value, the chance of it going lower is greater. So even if you see some kind of double llama pattern, you think, yeah, it's time to buy. But what if it turned into a triple llama pattern, it's going down? Well, if you knew that it had a better, if you thought the odds are higher that it would go down, you might strategically plan a little different or avoid that stock. So that's one thing. And even day trading, it's very common in day trading to put like a stop loss. So even if you think it'll go up, but if the price dropped below your threshold price, you'd automatically sell off your stock, so that you do have a loss, but a less loss than you expect. So these are kind of the ways of thinking and the benefits of pricing. So you can improve your strategy that way. Now, how many prices should you put on a stock or any investment? And I kind of think in my opinion, you should put at least 2 on to improve your mental awareness and your possibility of doing well with it. So when it comes to a stock, if you put a price on that stock at the beginning, you think this is what it's worth now. Okay, maybe it's fair value or undervalue or whatever. And then in the future, it's worth, you put a price in the future and you think, okay, it's going to be worth 10% more. I think this is a good buy. So you buy it and increase your chance of getting 10% more. And the better you are at pricing, the more likely this is going to happen. So that's basically what I think. You might want to put more in there in case you want to time dips, go in and out of stock, something like that. But in general, 2 would be a good idea. Now, examples of this. A lot of people don't know how to price stocks. So the real thing is there's many ways to price stocks. And an example would be price to earnings. This is a very simple one. So when it comes to price to earnings, you're looking at earnings for a company for a year. You're saying, okay, how much does it make this year? And if the general price to earnings of companies in all the world are about 22, or at least the S&P or something would be 22, or maybe 18 to 22, so maybe say 20. Then if it had $1 of earnings, its price to earnings ratio of 20 would give it a fair value at $20 for a stock. But then you could use that number, and then if you wanted to kind of give yourself an estimate of, okay, what's the future, it's actually pretty easy. These days on the internet, PE is very widely available for most companies, and forward PE is also available, which is an estimate from an analyst or more analysts of what they think in the next year or so it's going to be. And so all you have to do is basically look at the price to earnings and the forward price to earnings and say, okay, what if the price to earnings ratio is 20 now and the forward price to earnings ratio is 10? Then that suggests analysts think this company is going to double its value within a year or so. And so that just gives you an indication of, oh, if it works out, this could be really good. And then another common evaluation metric is price to book. And this kind of gives you your assets. So the book value is your equity. So your assets, total assets minus your total liabilities. And so if you have that, you have the equity of the company, and you can say, okay, if it's at 1, you're basically paying for whatever material they have at that company. And then whatever they earn from it, that's just, icing on top. So if you get a price to book ratio of 1, it can be a good buy. Now you might have to do more digging, but imagine a price to book ratio of like 0.2. Well, a price to book ratio of 0.2, that's like, imagine you there's a $500,000 home in the market price, but you're spending $100,000 on it. That's so cheap that you can imagine that if that house, for some reason you couldn't hang on to it any longer and you had to sell it, the market price is $500,000. So even if you sold it for less, you'd probably break even or do much better. than your initial investment. So that's one thing to think about with price to book. So it's a good metric too. It can be useful. And then another common one maybe is price to sales. Now this one I kind of think is it's risky because it's something like Amazon is valued. The most favorable valuation of it that it has is based on price to sales probably. And that one would be, because they have a lot of sales, people kind of think, oh yeah, they're going to dominate the market. It might work, and people who have invested in Amazon, a lot of people have done well. So that might be one way to go, but I think it's really risky because you could look again like at a house scenario. Say you have a house that's renting out for $10,000 a year and it's worth $200,000 on the market. So you think, okay, its sales are $10,000 and maybe 20 times that is fair value. A price to sales ratio of 20 is okay. But then what happens if the next year suddenly it doesn't have any sales or like any rent, or it has half the rent price paid? Suddenly your sales have dropped, and that's an issue. So you kind of have to look into the future. Or what if your renters are running some kind of fabrication shop inside their building, and you've signed some agreement where that they can use all the electricity and water that they want, and you're paying for it. They might end up spending $2,000 a month. So even though your sales are $1,000 or $20,000 a year, let's say, even though you're getting $10,000 for sales, you're spending $20,000. You're actually losing $10,000 a year, and you're not going to be successful over the long run. So it's very risky in that way. But anyways, that's kind of my thoughts and a very brief example of pricing. As far as pricing goes, you can improve that strategy. Like for forward price to book, I mean, you have to kind of look more deeply into what you think the growth is going to be for a company. A lot of people like to estimate 1, 3, 5 years out, maybe more, to kind of look at their growth trajectory, and you might have to read, the company's strategy to find out how to do that. Which is usually they have guidance or strategic visions that they publish. Even annual reports might have a little bit of information. So you can look at those kind of things. Or you can even look at past data, which is not always accurate for what's going to happen in the future, but it can be an indicator for a very stable company. So you could look at, okay, yeah, in 5 years they doubled their equity. So maybe in the next 5 years they're going to double again. What's the price book ratio at now? So will it be a good value in the future? And that gives you a sense. And then, you can add into this, okay, the PE ratio of 20 might be reasonable, but what if it's in a sector of the economy that usually has a PE ratio of 17 or 12 or something? Then you might be below 20, so you might think it's a good deal at first, but if you add that extra factor in, you might say, oh no, it's not as good a deal as I thought. So basically, there's lots of different ways. You just kind of incrementally get a better pricing strategy. But that's the way I would suggest, like this is kind of a beginner of like how you would set a price, I guess. And that would help you get mental wealth, at least, because you get a sense of peace in your mind. Well, in the market's very irrational. Over time, it kind of goes towards these trends, so it does work out in the long run investment. But in the short term, it may not work out that way, but at least you get that benefit of peace of mind. And when it does drop, you think, no, it's still cheap, so maybe I'll buy more instead of, oh, it just dropped, maybe I'm going to sell because I have no idea where it's going. So yeah, I hope this was an interesting topic. Feel free to comment if you want. Otherwise, thanks for watching, and I'll talk to you in the next video.